Oil is swinging from gains to losses this morning as hawkish signals from U.S. Federal Reserve officials undercut a risk-on mood that was really set off yesterday. That's after 7 straight weeks of declines that brought futures to the lowest level since June. That was just before the Fed meeting. For a view on where oil prices could go, let's bring in Francisco Blanch, head of commodity strategy at BofA Global Research. Francisco, thanks so much for being with us. I mean, this is sort of like a pin the tail on the donkey sort of trade right now. We were looking at 90, we were guessing at 100, and then promptly we came down to below 70. How do you think about how this all shakes out in 24?
Well, first, thanks for having me. We are still on the constructive side in oil, despite the fact that the fundamentals are granted a little softer than we anticipated. Coming into the end of this year, we put out our projections in November, arguing that OPEC would likely deliver a big cut in their following meeting, which they kind of did. But I think the market lost a bit of confidence in their ability to maintain supply and demand in balance. And therefore, we started to see downward pressure building on prices. Of course, the last few days, we've seen a bit of a reversal of that with the interest rate cuts priced in by the market heading into next year by the U.S. Federal Reserve, and we've had a bit of an uplift. Now, so where does that leave us? Well, in reality, I think as rates start to come down, we're going to see more support for oil prices. We're, after all, looking for a soft landing in the global economy and the U.S. economy in particular. But also, I think the geopolitics are incredibly complicated here. There's a lot of things happening simultaneously in different parts of the world, and we're really worried about those. Even just a few minutes ago, we saw Maersk, the Danish shipper, stopping all vessels going through the Bab el-Mandeb Strait in the Red Sea as a result of fear from those attacks we've seen from the Houthi militias in that part of the world.
So geopolitics combined with supply discipline seems to get you to $86 per barrel in 2024, so higher than where we are right now. Talk to me about the wild card that is U.S. oil production and how much stock you put in those charts that make it look like oil production's, back to record highs out of the U.S.
Yes, this has perhaps been one of the biggest surprises this year, together with the incremental volumes from Russia, from Iran, and that last-minute 6-month reprieve on U.S. sanctions granted to Venezuela. So we've seen not only those nations that I mentioned deliver more volumes than initially we and I think the market anticipated, but also this story on U.S. shale has continued to go on. And I think at the beginning of the year, in 23, we thought U.S. shale supply is going to grow modestly because the rig count is falling, because there's less capex devoted to drilling activity and developments. And the reality of the matter is, as you pointed out, U.S. shale supply is now at the record level, over 13 million barrels a day. And we've seen growth, which is kind of consistent with some of the best years in U.S. shale history, about 1.5 million barrels a day of crude oil and liquids like ethane, propane, and butane. So it's been a lot of supply. And not only in oil, I would argue gas, shale gas supply in the U.S. has also surprised to the upside, one of the reasons we've seen lower gas prices in America. So yes, that's a challenge. And if the growth continues into 2024, we're going to have to reconsider some of this supply-demand balances that I just discussed.
All right, that's interesting. I wonder what you also think and how you discuss the role of financial markets and where these commodity prices ultimately trade. That's something we hear a lot about, especially on the downside. The short sellers are sort of in control of crude oil, the financialization of these, hard commodities.
Well, I mean, I think financial players swing it both ways, right? And at the moment, it is true that we are seeing very low speculative long positions, and certainly on our CTA models, we're looking at outright shorts across the energy complex, particularly oil. And frankly, some of that can unwind quickly, as we've seen for the last few days, when that risk on appetite comes back into the market. So I do think that there is certainly an impact of financial players in the market, but I do think it's very short run. And I think eventually prices do settle where supply, demand, and inventories drive them. And that's actually what we are really focused on. I mean, financial players can definitely alter the week-to-week movements in prices, but not so much over the course of 3-6 months. That's ultimately, like I said, it's what happens on the production side, what happens on the consumption side, and how high or low inventories will be.
And even if we can extend out of that kind of near-term view, a lot of questions that we get from viewers is, why are we talking about, rising oil prices, rising oil demand, when we're supposed to be in this world of weaning ourselves off of fossil fuels? I mean, there was COP28 where kind of this lighthearted commitment to do that with enough room to let other players still engage in fossil fuel production. But, does a commodity do well when it seems like the world wants to move off of it?
Well, the answer is it depends, right? Last year, for instance, we saw thermal coal prices reaching record levels. In fact, thermal coal traded below oil. Right? I mean, as people in the industry would put it, dirt traded above black gold for the first time ever in history. I mean, and it happened as we were trying to wean ourselves off from thermal coal, which frankly is the biggest challenge to climate change. I'm not saying oil and gas are not challenging to deal with, but I do think that at least weaning ourselves off thermal coal, that should be the easiest and the first thing we tried to do, and we didn't do it last year. Last year we saw a reversal of that as a result of the Ukrainian war and the loss of Russian gas supplies into Europe. So, I mean, I do think it's premature to say that oil prices will go into a permanent structural decline as a result of consumption rolling over. I do think at least we have 5, 6, 7 years ahead of us of reasonable oil demand growth, followed eventually by a flatlining period of around 5 to 7 years, and then eventually declines. But moving away from fossil fuels, for as much as we want to do it right here, right now, and there's all these commitments from COP28 and other countries, it's a difficult thing to do because 80% of our energy today still relies on those fossil fuels, right?
That's interesting perspective. Before I let you go, just want a quick question on natural gas. Any hope for natural gas? A chronically kind of oversupplied market. How does it play out next year?
Well, look, I mean, we had a bearish view coming into the year for natural gas, and it's playing out faster than we anticipated. I think perhaps the most surprising data point that I can share with you is that production in the U.S. is above 105 billion cubic feet a day. To put that into context, that's the number we thought we would get to next year. We were projecting to be at 103 or so right here, right now. We are 2% above that. So I know it doesn't sound, maybe big scheme of things, 2% doesn't sound like, but actually it's a lot, because it really changes the balances over the course of the winter and into next summer. And that's the difficulty for natural gas. Domestic demand in North America is pretty stagnant outside of Mexico. And all the growth really is driven by liquid natural gas exports. And those are not really coming through in full force until the end of next year and into 2025. So it could be a bit of a slug for natural gas, I think. We remain kind of negative here. Now, if the weather turns, of course, there's always a chance of prices rallying, but we are going to have to wait for those big liquid natural gas terminals, liquefaction terminals, to come online and start soaking up all that surplus that U.S. shale gas producers are delivering into the market.